Today we'll be asking whether the Bank of England is about to accelerate its interest rate cutting cycle. The Bank of England is widely expected to cut interest rates from 4.75 to 4.5% at midday today. But the question remains, why are interest rates still so high? Unlike the US, UK growth is stagnating, and although the labour market data is invalidated by a low response rate, other indicators point to a rapid deterioration in the labour market. Newly appointed MPC member Alan Taylor recently made the case for as much as 1.5% of rate cuts this year. That compares with market expectations currently of just 85 basis points of rate cuts. One reason for the bank's caution in cutting interest rates is perhaps that the Office of Budget Responsibility and the bank themselves initially characterised the October budget as expansionary. That judgment now appears to have been a mistake, and most economists now view the budget as having been contractionary. There are concerns about the impact of the increase in national insurance contributions paid by employers and the increase in the national living wage on inflation. However, the Bank of England would likely look through these as one-off effects, especially if they resulted in a decrease in employment. In any case, with the Chancellor's fiscal headroom now exhausted, it's likely that further fiscal tightening happens in the next few months. This would put more onus on the Bank of England to cut interest rates, and if the impact of interest rate cuts is as muted as the impact of interest rate hikes was, then that means that the Bank of England will probably need to cut interest rates more aggressively. All this adds to the case for UK gilts, not just as a diversifier for multi-asset portfolios, but as a source of positive return in their own right. Thank you for listening.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.